Well, thank you so much for the invitation. You have a great seminar series, and it's a great honor to be a speaker. My name is Artem Streltsov. I am a finance PhD job market candidate from Cornell Johnson. And today I'm presenting a paper co-authored by Chiho Ruan, who is a PhD student in economics from Cornell. In this paper, we investigate how perpetual contracts affect underlying market quality, and we use cryptocurrencies as a sandbox. First of all, what are perpetual contracts? Perpetual contracts were introduced by Robert Shiller in 1993 in his seminal paper. He proposed the perpetual contracts to continuously price illiquid assets using real estate, human capital, or economic indices as an example. Perpetual contracts, however, were never implemented in traditional markets, so his idea was never realized in traditional markets. But in cryptocurrency space, for the first time in 2016, perpetual markets were created to price Bitcoin. Perpetual contracts trade 24/7, just like underlying cryptocurrencies. They enable continuous price updates, and the price feeds are transparent because of the blockchain technology. The market impact of perpetual contracts is immense. They account for 93% of cryptocurrency futures market, and in fact, most of cryptocurrency trading takes place in derivatives. So perpetual contracts play a large role in the cryptocurrency space. They have over $90 trillion in trading volume since 2020, which is comparable to the gold market or the US Treasury market. So what makes...
Can I ask a question?
Yeah,
Sorry,
absolutely.
I'm not really familiar with, but perpetual contract is kind of it's a continuous derivative.
Yes.
Like so there is some derivatives that are not continuous and some of them continuous. So if they are continuous, it's mean that it's so you use this term?
Yeah, I think this slide might answer some of your questions. So you have the traditional futures contracts, right? Which have an expiration date, a settlement date, right? Perpetual contracts don't have a settlement date. So you can just hold the position indefinitely, and you don't need to roll over the contract. And the prices in the two markets, the spot market and the perpetual market, are kept close to each other through this funding fee mechanism. So there's a very special mechanism designed in the perpetual contract that keeps the prices close in the two markets, that allows it to track the spot market, if that makes sense. So this funding fee mechanism has an 8-hour cycle. So you can think of perpetual contracts as settling kind of every 8 hours. And the payment direction, so either the short side pays to the long side in the perpetual markets, or the long side pays to the short side. In this direction, it depends on the difference between perpetual and spot prices. And the amount of this payment also is proportional to this deviation between the two prices. So as I mentioned, like perpetual contracts are very popular in the cryptocurrency space. Why? Why would they be popular? Well, first of all, they have much lower transaction fees than spot markets. They also have faster execution because there's no on-chain verification. They also allow leverage, and there's also access to short selling. All of those advantages together increase the market liquidity of perpetual contracts. And now that we have the fact that perpetual contracts are more liquid, that is also another advantage over spot markets. So it's like an endogenous feedback loop. So this is how perpetual funding fee operates, right? You have futures market, you have the spot market. If the futures price is greater than the spot price, then the long side holders of the long position in the perpetual markets pay a fee to the short side at funding time, right? And this way, the traders are incentivized to keep the prices in the two markets close to each other. So the research questions that we ask in this paper are as follows: how perpetual markets or contracts affect the quality in terms of market microstructure of underlying spot markets. How do they affect informational efficiency, price discovery, and so on. And we focus on causal identification in this paper, and consider three quasi-natural experiments. Two experiments with perpetual contracts trading, and one experiment with perpetuals being absent. Those with perpetuals trading are the exogenous nature of the market funding times, because it's written in the contract, right? And then also the introduction of perpetual contracts. The experiment absent perpetuals is the 2021 perpetual trading termination on Huobi, which is a major Asia-based exchange. And they terminated perpetual trading in 2021 while spot market was still operating. And so our findings are that perpetual contracts increase spot market quality, informational efficiency, liquidity, trading activity, but this comes at the cost of wider bid-ask spreads due to heightened adverse selection risks. So you can think of it as, yes, you have this higher liquidity and trading activity, but at the same time, you have higher transaction costs. And it is the retail traders who bear the cost of this high informational efficiency. And this finding is consistent with information-based microstructure theory. The data set used in this project is provided by Kaiko. We have access to both high-frequency trading data and to order book snapshots for more than 100 token pairs in both spot and perpetual markets, 10 exchanges, including major ones, but also some smaller ones. And the data spans from 2017 up to 2023. We consider a number of, yes.
So it's only centralized exchanges, right?
Yes, correct.
Okay. I guess you're going to say how you kind of try to avoid the impact of the decentralized exchanges.
Well, we kind of just abstract from them. But for the main part, we didn't consider them because of the way we construct the measures. Because it's decentralized exchanges, the market structure of those markets is slightly different.
Yeah.
Yeah.
But
It's
also
something that we can. Yeah.
there is perpetual trading also on decentralized exchanges, right?
Yes, I think so. Yeah.
So yeah. So in some sense, you can try to do the same exercise and see if you get the same result in the centralized exchange, but you need to modify
Yes.
the bits. Yeah. Okay.
Yes, very good. Yes, yes. That's something that we could try as well. All right, so we consider a number of market quality measures. Order imbalance, which is essentially a measure of liquidity. Then we have volume synchronized probability of informed trading, measure of toxicity or adverse selection risk. Then we also consider percentage quoted spread as essentially the transaction cost, which is the bid-ask spread divided by the midpoint. The first question to ask is, how do the statistics between perpetual and spot markets compare, right? And turns out that obviously, right, there's much more trading volume in perpetual markets. Order imbalance is smaller, so the perpetual contracts are more liquid. You would expect that. But turns out that perpetual contracts are also more toxic. They have more adverse selection risk by 31% as compared to the spot markets. And that affects the transaction costs. So percentage quoted spread is actually 14% bigger than in the perpetual markets than in the spot markets. So there's more informed trading, even though there's more liquidity, but there's also more informed trading in perpetual contracts. All right, so let's move on to the perpetual funding times, or this funding mechanism, right, underlying perpetual contracts. If you remember, every 8 hours, the funding fee mechanism automatically makes money change hands, right, between long position holders and short position holders. And it attracts the prices in spot and perpetual markets. since everyone knows that money will change hands, sophisticated traders are likely to trade strategically around funding times. To arbitrage away the differences, but also try to earn some funding fees. Um, so the first question is whether there's any bunching, right? Whether there's indeed any strategic trading in the perpetual markets. And on the right, you can see a plot. This is in a way, a distribution within each 8-hour window of by hour, the distribution of trading activity. As you can see, immediately after funding time, and immediately before funding time, so this is times 0 and times 7, there's much more trading activity happening than in the middle, right? So it's like a W-shaped trading pattern. If there were no bunching or strategic trading, you would see like a uniform distribution, right? Which is the red line. And we confirm using Cressy-Reed power divergence test that this is not a uniform trading pattern. So indeed, there is bunching in the perpetual markets around funding times. So you should expect that to happen, right? But what is interesting is that if you look at spot markets now instead, you see the same picture. So on the left, we have perpetual markets. On the right, we have spot markets. So perpetual market funding times are affecting the trading pattern in the spot markets as well. So every 8 hours in the spot market, you see more trading activity immediately after perpetual funding time. And nothing else happens every 8 hours, right? But not only that, if you compute probability of informed trading, it also has the same pattern within each 8-hour window. So there's more informed trading in the spot markets around funding times. And then also, if you look at bid-ask spreads, they also widen around funding times in the spot markets. So that was in pictures. I showed you the idea of the paper in pictures, but now let's actually statistically test all of this. We start with a treatment effects regression with exchange token fixed effects and the time fixed effect. We consider three kinds of treatment windows, 1 hour immediately after funding time, 1 hour before and after funding time, 2 hours before and after funding time. And the way we uh, uh, compute the outcome variable here is slightly different. It's tricky. It is a ratio relative to the non-funding time average immediately before. So this way, the beta, the treatment effect, will be the percentage change from the funding time. And these are the results. So we find that perpetual funding time increases, or perpetual markets, I would say perpetual markets during funding time increase trading activity in the spot markets by 50% on average. At the same time, they lower order imbalance by almost 5%. So markets become much more liquid. The spot markets become much more liquid around funding times. But at the same time, at the bottom, you can see that probability of informed trading is going up by 17%. So markets also become much more toxic, and adverse selection risk is going up. And at the same time, transaction costs also go up by 3%. So we confirm the pictures that I just showed you. Everything is significant at 1%, and the effects are very much sizable.
So I have a question.
Yes. Yeah.
First, can you explain a little bit about why it's 8 hours and why everyone use 8 hours, and like what is the reason to pick a 8 hours trading window, and if everyone follow the 8 hours? And the second
Yes.
question is, because something that is unique in crypto markets, that you can spot market trade 24/7 as well, right?
Yes.
Which is not like traditional finance that
Yep.
so the trading activity is the same the entire day, like how it works in the 8-hour windows.
Right. So first of all, why 8 hours? Because that's how perpetual contracts were defined when they were implemented. So I think that was the decision by BitMEX, the exchange, and everyone else just followed. The next question is whether different perpetual contracts in different exchanges have a different window. Is it the same 8 hours? Do they overlap? And if they do not overlap, then that's an interesting experiment, right? Um, Already to have. And we had plans to do that. But when we actually checked, the windows in the largest exchanges overlap. So yeah.
So it's
The
kind
next
of
question is, yeah.
the first one that implemented it did 8 hours and everyone followed it.
Yeah, everyone just followed it. And
Okay.
then the next question is, what about the trading activity throughout the day, right? Well, cryptocurrencies are essentially global. It's a global market. Um, but some exchanges are more present in some countries, others in other countries. So there's a lot of trading activity coming from, China. There's a lot of trading activity coming from Europe and some activity coming from the United States as well. So you see kind of trading happening during most hours. And we're looking across 10 exchanges, so it's really like covering the whole globe in a way.
Yeah, but something that I think would be nice if you can check is we have 8 hour windows. So my bet is that if you can control the windows, like first windows, second windows, third windows, whatever, you will maybe find that the price discovery process of the thing that you showed us may work in specific windows and not in all of them. Um, because I think it's kind of the driven of the market when the players are playing, and
Right,
I'm not
right.
sure if everyone is indeed 24/7, you know.
Yeah, yeah, yeah. Yeah,
Um,
yeah, that's a great suggestion.
and also it can give us some intuition if the USA market is um, pushing stuff more than the other time zone or whatever.
Yeah, that's actually great. It's a great comment. Um, yeah, we'll look into that.
Yeah, it's just like interesting to see. Okay.
Yeah, yeah, absolutely. It definitely is. Yeah, thank you. Very good. All right, so that was a binary effect, right? Whether we are within a treatment window or funding time window or not. We also can use funding rate as treatment dosage. So funding rate encodes the deviation between spot and perpetual prices. It aggregates information from various sources, it's market sentiment, regulatory development, adoption of technology, and macroeconomic factors. And they're typically positive. Funding rate is typically positive on average, I would say, right? And a negative funding rate signals bearish sentiment in the market. So if we repeat this regression, but now instead of using a binary treatment, we just use this continuous funding rate measure, and the definition is given at the bottom left. It's essentially the percentage deviation of perpetual price from the spot price. That's how it's defined. So first of all, notice in the rightmost column, the bigger the deviation, the bigger the effect, as you should expect, right? Well, everything is significant at 1%, but the bigger the deviation, the bigger the effect in terms of liquidity and average selection. But then also, it seems like um, in the second to last column, average selection risk is particularly high when the spot price is greater than the perpetual price. So when the sentiment is bearish. Um, and we attribute this to ability to short sell and also use leverage in the perpetual markets. So that's an interesting finding. The next experiment is now to use perpetual contract introductions instead. So we are identifying 95 introduction events for 75 token pairs on three major exchanges, Binance, Huobi, and OKX. The data spans from 2019 to 2022. This is purely due to data availability because we needed a perfect sample, right, for staggered diff and diff. And we use the Callaway-Santana estimator, which is the golden standard for staggered differences and differences. We compute monthly averages of outcomes for each token exchange. Those are not at the monthly, so the monthly, daily, uh, daily outcomes averaged within a month, I should say it this way. And we take 12 months before and after each introduction as the analysis window. First window to check the parallel trends hold, right? So this is trading activity. As you can see, there's no pre-trend before introduction of perpetual contracts, and immediately after introduction, there's a jump in trading activity. This is order imbalance. So there's essentially no pre-trend as well. and there's a drop in order imbalance. So market liquidity improves. Then this is the probability of informed trading. It also like no pre-trend, then it jumps up after the introduction, and then it seems to be decaying, as you can see. What is interesting, like 1 year later, there's already no effect, which I suspect is due to higher trading activity. So trading activity goes up, it picks up after the introduction, and now the informed traders are better masked, if that makes sense. Hiding, they're hiding in this liquidity.
Can I ask a question? Sorry.
Yes.
Uh, I wonder, pre-treatment, I agree there's no trend or something, but it almost seems like there's some sort of seasonalities going on in all of these graphs. And I wonder how much that would change the estimation of the treatment effect.
Did you say seasonality?
Yeah, it's almost like
Seasonality.
you see some ups and downs um,
Yeah.
for this one, and then I think for two slides earlier, it's even more salient. Um,
Like this one?
yeah, it's almost like you're looking at a sine alpha graph. Um,
Yeah, it is
yeah,
interesting.
so I'm not sure
Yeah.
how do you think about this,
Hmm.
whether or not your estimation of treatment effects would change due to this.
Right.
But
So
yeah.
we would need to think about this, but I suspect this is just market sentiment. Um, it's the reversal, the short-term reversal that's happening. It's my suspicion, as simple as that. But the fact of the matter is that there's no like statistical significant, they're not statistically significant, right? Those um, even though it oscillates around zero without statistical significance. So to me, that is like good enough in a way. Um, but the very fact that it exists, it really is an interesting question. Yeah. And my guess is that this is indeed the reversal patterns.
And
Very good.
and
Yes.
I have a question about the introduction. So because you mentioned that there is different tokens or whatever that I guess each
Yeah.
one that they start like allowing to trade, it's kind of the introduction, right? But
Yeah.
there is do you control by exchange? So for example, if Coinbase already have perpetual contracts on Ethereum,
Hmm.
and 1 year later you have Binance joining. So the question is if you can see also impact of one market over the other, or you
Hmm.
always control for the same exchange.
Right. Well, first of all, we use separately, we tried using never treated and not yet treated as controls, and the results stand. So it's
Okay,
robust to that. But then also we use the Callaway and Santana estimator, which, averages over uh, separate effects, if that makes sense.
I see. Okay,
Yeah.
great.
So it's not a two-way fixed effects.
I see.
Yeah. Anyway, transaction costs also go up, post introduction. Um, and these are the regression results now from the same estimator. So we find that dollar volume goes up by $98,000 on average per day, I believe. Order balance goes down, so more liquidity, but also more informed trading. We have by 1.1 percentage point, and the transaction cost also goes up by almost 1 percentage point. And to put that into perspective, right, um, we look at the average pre-treatment for each outcome. What is the average in the spot market pre-treatment for the exchange? Um, and the average effect is a 150% increase in trading activity, uh, 10% decrease in order imbalance, 16% higher probability of informed trading, and almost 200% increase in transaction costs. Yeah, and as I said, results are consistent if you're using never treated or not yet treated as controls. We tried both. All right, the final experiment is, let me just take a sip. The final experiment is to study the reverse effect. So in 2021, on September 24th, China essentially banned cryptocurrency activity, right? And 1 week later, Huobi, which is a Asia-focused exchange, a major Asia-focused exchange, they announced plans to terminate perpetual contract trading on October 28th, but they would continue spot market trading up to December 15th. While other exchanges such as OKX, Binance, Buybox, KuCoin were not affected by this because they continued the perpetual trading operations. And so we have a plausible differences in differences as long as we can construct a good synthetic control. So we use those 4 exchanges, and for each token separately on Huobi, we construct this synthetic control by finding an optimal vector of weights. And we feed this optimal vector of weights using 1 month before the announcement by China. So when there's like no news about any of this, so we determine what the counterfactual would be. And using this optimal vector of weights, we apply it to the same exchanges post actual termination of trading, and that is our counterfactual for the post. And then we just run a differences of differences regression. This is a standard differences of differences regression. You've seen this equation a million times. Well, first of all, what about parallel trends, right? For instance, on the left, as you can see, this is order imbalance, Huobi versus its synthetic reconstruction, let's say. Before the announcement, as you can see, they're really close to each other. And then after termination, as you can see, Huobi is higher, so liquidity worsens post-termination. Running actual dynamic effects regressions, we can see here order imbalance indeed. Before termination, there's no real difference, so trends are fairly parallel, I would say. And then post-termination, you see that there's a jump in illiquidity. Well, illiquidity is a different measure. Jump in order imbalance. Similarly, this is for trading volume. As you can see, no pre-trends before, and then it just drops post-introduction. And this is the regression. So we find that dollar volume indeed goes down. We also find that order balance goes up, so liquidity worsens from termination of perpetual trading. Transaction costs also go down, and surprisingly enough, probability from trading goes up. We don't really have a good explanation for this. This is the only thing that we don't have an explanation for in terms of regression results. Right, so the takeaways, right, are we have 3 experiments and they align in their main findings. The main findings are as follows: that perpetual contracts increase the quality of spot markets, informational efficiency, trading activity, and liquidity. But they also make markets more toxic to market makers, right? This is where the key mechanism, right? And that widens bid-ask spreads, increasing transaction costs. And who are the main traders in the spot markets? It's the retail traders. And so uninformed spot market traders bear the cost of higher efficiency. And we can directly attribute this effect to the funding mechanism because that's where, as you saw, that's where most of this effect is happening.